Hi and good morning. Hello. Hi. I know there are a lot of things which are much more interesting than a guy standing here on a podium, which will catch your attention. But I'm anyways gonna go ahead and bide my time. So this is Manu Singh. I'm the CEO of TDMM, TradeDog Market Making. We are a market maker. We make markets on centralized and decentralized exchanges. And today I'm going to talk about markets and token management. I believe anyone and everyone here is involved in some capacity or other in the markets. So let's talk about them. The TDMM logo, in case you missed it there. Right, guys. The upward trend in cryptocurrencies has been too big to ignore, unlike this stage. The total market cap went up to $3 trillion. Now, to anyone who's still listening, just to put that in perspective, $3 trillion represent like 1% of the total global wealth. The total global wealth is around 300, $350 trillion. So cryptocurrencies are like the fourth most popular type of investment. The first one being real estate. I mean, the most valuable thing on earth is earth itself. It's real estate. It's around $300 trillion. Then stock markets and then crypto. So to put it into perspective, cryptocurrencies account for 1% of global wealth and around 5% of stock markets. That's a considerable number. The market capitalization went up 320 times since 2017 and more than 30 times since the corona bottom. El Salvador has adopted Bitcoin. So, talking about the number of actual users, crypto has 82 million unique users. Global crypto users reached 295 million in December 2021. That was the top. Uptrend is DeFi is just a beginning. We at TDeFi are talking about DeFi. DeFi has the power to disrupt the global market value of financial institutions, which is 500 billion. DeFi protocols still have a TVL which runs in hundreds of billions. And Ethereum alone settled transactions which surpassed Visa, the largest payment processor. Now introducing TradeDog. So TradeDog is our financial advisory which caters to the retail crypto audience. In TradeDog, we provide in-depth market analysis, crypto research, news, events. These are some social statistics about TradeDog. So India is home to the largest retail crypto community, and you can see that in the social media numbers of TradeDog. So we are here at the TDeFi Pavilion talking about TDeFi. It's the crypto incubator and advisory. I represent TDMM. We are the market maker across centralized and decentralized exchanges. And there's TDVC, which is an early stage crypto focused fund. The TDeFi portfolio, you can see them on the sides. You can see them here. You have a project from every subcategory within the crypto ecosystem, be it metaverse, gaming, DeFi, exchanges, or infrastructure and utility. Now, understanding crypto tokens as publicly traded assets. I think some of the gentlemen on this side are from the traditional markets. So it would be nice to draw some parallels between traditional publicly traded assets and crypto tokens. Talking about charts, since I'm the market maker, I'd start by saying charts are as immutable as blockchain. You know, whatever happens in Vegas stays in Vegas. The same goes for blockchain, the same goes for charts. The immutability of charts is nobody can change the historical pattern. Whatever has played out on your charts remains on your charts. So traders and investors alike, they will only invest in your project. They'll only punt on your project when they see a profit making opportunity. So in a nutshell, there are like two important parts of a token life cycle. Number one is token economics modeling. Token economics, it's a very hype term. I wouldn't be surprised if any of these Ivy Leagues in future has a course on token economics. Then comes token liquidity. So token economics, in a in very layman terms, it's the mathematical expression of your business model. It's how you express your business model in terms of your token distribution. What percentage of your token supply goes for what utility? That's what token economics is. It's, as I mentioned, it's about translating the entire business model into transactions and threading them further between fees and velocity. Now I'll explain what I mean by fees and velocity. So the essential components which need to be kept in mind while devising a token economics. I'm sure all the projects here have undergone this exercise. The things to keep in mind are you need to have a zero sum model. What I mean by zero sum model is your rewards, your yields should not outrun the revenue. In Web 2, they used to say if the product is for free, you are the product. In Web 3, I'd say if you don't understand the yield, you are the yield. So the sources of revenue are equally significant like engagement rewards. We have seen a lot of startups, Celsius Networks, for example, who emit high amount of tokens to keep the user engaged, but increases the sell pressure. You know, the same has happened in some algorithmic stable coins. Now, talking about token velocity in a nutshell represents the differential between the token as a store of value and a means of exchange. It's a trade-off between how many people are whale holding your token versus how many people are actually using it for its utility purposes, transacting it. So based on the utility of the token, the velocity needs to be optimized. Like if the yields are increasing and many people are holding the token, the same needs to reflect in token emission to somehow bring things back to equilibrium. Talking about the current reality versus the best practices, uh, standing on the TDeFi stage, I think we are well positioned to talk about this. As you can see, the average age of a crypto entrepreneur is 30. That's right about my age. The average team size of a crypto startup is 15 to 25 people. So a lot of these people end up with a token which practically has no value, thus, killing their dream. Yeah, man. So with a team of diversified people with diversified experiences in the traditional as well as crypto markets, we recommend these best practices which can be followed so that your token at the very least remains liquid. Number one is treasury management. It's very important to have a diversified treasury. Every project, right from the beginning of seed funding, starts building its treasury. So it's as simple as saying not to put all your eggs in one basket. Like Tesla, I mean, all of us had Elon Musk on notifications on Twitter at some point in time. So Tesla had a diversified treasury. They invested into Bitcoin. They publicly announced their entries and exit. So token companies could start by allocating a portion of their inventory to large caps so that their token is intrinsically tied with the direction of the market. If the market goes up, this can ensure that their token actually performs as a higher beta and performs better than the overall market sentiment by pegging a portion of treasury to it. Then comes buybacks and burning. Buyback is also regulated exercise in the traditional markets. Companies are supposed to publicly announce buyback on various news portals. The same can be done uh, in crypto. You can announce public buybacks and you can publicly burn those tokens, effectively increasing the market cap. What we have seen is typically if you burn 1 million worth of token, your market cap pumps by a multiplier of 20 to 50x. That is the increase in value you see. Now talking about market making, liquidity is a necessity. Liquidity is basically the ease which you can convert your cash into a set token and vice versa. How easily you can enter and exit a market. How easily you can buy and sell a token. And for that, in simple terms, somebody needs to be on the other side of the market. That's typically what market makers do, even in the regulated markets. Now, here's a chart depicting life without liquidity. I'd say it can be termed as every crypto project's founder's nightmare. Nobody wants to have a chart looking like this. I mean, there's ample volatility. A simple market buy gives you a 50% upside wick. A substantial market sell gives you a 50% downside wick. And after that, the market comes back flatlining. It doesn't resolve anywhere. Now, this volatility is not a function of any trend. It's not some organic trend. It is simply because there are not enough buy sell orders in the market. There's not enough liquidity. So anybody intuitively looking at this chart, whether he doesn't understand technical analysis, would not like to be invested in a market like this. So basically, you can see there's hardly any volume and there are erratic price fluctuations without resolving in any direction. You need basic liquidity for a market to flow in a particular direction, to create an organic trend, to gain investor sentiment, and to have actual buyers and sellers for your market. Now, talking about market making and token management, this is largely defining our role, putting it on paper, what we do. These are the basic services that any market maker for that matter provides. Exchange listing is a very important part for any token. It's an important milestone in a founder and a token's life cycle. So it starts with a pre-listing in-depth market analysis. You do an exchange listing analysis. You analyze what kind of buyers you can expect, what kind of investors, what kind of exits from the seed round participants can be expected, to start with what inventory you need. That's all part of pre-listing analysis on an exchange. Market making, coming to the actual market making part, every market functions in the form of a public auction. Every market is a public auction. There are order books, there are players bidding on the buy side, there are players putting asks on the sell side. So you need to have a minimum threshold bid ask spread. It's not like you can have a $20 price with a $10 buyer, $30 seller. It doesn't make any sense. A market maker also manages arbitrage across various exchanges, the price difference across various exchanges. You know, your token is priced at $20 on one exchange, $30 on another. That's a function of inefficient execution. Somebody impatient rushed in and bought a lot of tokens, or somebody rushed in and sold a lot of tokens. So you need to normalize that. Market makers also provide volume support to survive on an exchange in 24/7, 365 markets with an initial community of 10 to 15,000 people. I mean, that's the kind of community size we see in initial stage projects. It's not uh, entirely possible. You need a market maker to create volume for you, to have some trading volume in your tokens 24/7. These are additional services of algorithmic and discretionary trading, which any market maker provides. A market maker helps you liquidate your tokens to generate inventory for your operational expenses, for your project to grow, for your marketing expenses. A market maker also helps you buy back and accumulate your tokens at the right time, if only you have exited at the right time. So basically, any market maker, what they do is they do continuous token management across different market phases of your project's life cycle. Now, I've put in a quote here by the legendary trader Jesse Livermore. He's known as the best trader to ever exist. The guy became a billionaire and also, in a typical trader fashion, went bust, went bankrupt more than 2 times in his lifetime. So he's a quote that the market is never obvious. It's designed to fool most of the people most of the time. What I have put in is order book display from Binance. This is a functionality which is available to the most retail of crypto investors. You can put in an iceberg order where on an order book you see a order of 10 BTC, but actually it will be 100 BTC. So now these are the different sexes and indexes we work with. Ending my presentation with why do you need market making in the first place? It's very intuitive and obvious. Basically, market makers induce liquidity to the market. Market makers make markets more efficient. and they increase participation, which results in a better price discovery, which helps your token get listed on different exchanges. Now, higher participations, higher volumes, stable price action, presence on multiple platforms, this sort of creates a, what do you call, ripple effect, a rally, and establishes your project, your token well in the markets. I'm going to take my leave now. Thank you.